Hello everyone, this is Professor Kent and today's recording is to take up some of the homework for chapter 3. Again, these are the exercises that I got from the book, and we're going to go through everything that we covered in chapter 3, most of the stuff that we covered in chapter 3. In this case, the first one was bonus. When it comes to bonus, we have 179 days as a corporation to pay for those bonus to have this deduction available to us. If we don't, then we have to wait till the following year. So now companies, this is Orkani Inc. has a September 30 tax year. So on August 1st, 2023, the company declares a bonus that 100,000 payable to Mr. Adgani, and an executive employee of the company. The company bonus is payable and paid. So they declared it and it was paid on May 1st, 2024. So when you think of a pay on, the limit is that you have 179 days after the year end. So after the corporation's year end, to make it a deductible expense for the corporation's year end. So corporation's year end. As a consequences, because they will not be deducted for the, if it's more than the 179 days, so it will not be a deductible for 2023. It will not be a deductible expense for the corporation. It will not be a deductible expense for the corporation. Now the question says how for the company and for the Mr. Rukani. So this is for the corporation, will not be deducted. However, in 2024, it will be for 24. Mr. Organi receive this bonus. If he receive this bonus, he will be including it in his income. It will, when would he include it? When it was paid to him. It was paid to him in year 2024. So that's what he will do. So they said, how would the answer change if bonus was paid on October 2024? So if the bonus was paid on October 24 for Mr. Organi, he will be he will be including it into their income. From the corporation purposes, they will be deducting it in 2025, not in 2020, because their year end is September 30th, 2024. It is done after the year end. If it's paid after the year end, they will, I'm trying to see if I could my pen stopped working. So for the second part, if the bonuses was paid on October 24th, for individual is the person who's receiving it, will include in his income these bonuses. From the perspective of a corporation will be able to deduct them when they're going to be deducting it for the year 2025, because this one, their year end is September 30th. So they will not be able to deduct it for the 2024, but they will be able to deduct it in 2025. So that was the bonus. Again, it is after the year end, not when they're paid, after the year end. So next question is that taxable benefit. So these are taxable benefit. When you look at the taxable benefit, these are the following cases, and then they said use the 5-step taxable benefit analysis to indicate whether this is the taxable benefit for the employee or not. If it's not a taxable benefit, why it's not a taxable benefit? Let's look at the first one. An employee received the latest smartphone from their employer. So of course they received a phone. So we wanted to know they weren't going to get it if they weren't working for the company. The phone retail value is 1,500. Now we wanted to know what do they use this phone in order to be a taxable benefit and not taxable benefits. If I were to look at it, they received it 15. The retail value is 15. The employer advised the employee that the phone is used primarily for the employment purposes, but for personal use is allowed. Any personal use require the employee to reimburse the employer. So if you use it for personal, you have to give them the money. So this phone is primarily used for employment purpose. There's no taxable benefit for the employee because this phone is used for for employment purpose only. So it is not a taxable benefit for the employee. Let's look at the number 2 or case 2. An employee, an office contains dozen of painting. The employer wants to replace many with abstract. So they have a paintings and the employer is getting a chance. The company decided to sell these to the interested employees. Now they have a paintings, and what they decided to sell them to employees. So they're selling it to the employees. First of all, when we think of it, it's an advantage because what happens in this case, you're getting the paintings because you work for this employee. So we wanted to know, is this a taxable benefit for this employee or not? So this is one employee pays 500. The paintings are worth $2,500. Paintings are worth $2,500. So what the company said that since you're buying it for $500, so the $2,000 will be a taxable benefit for this employee who decided to buy it. It will be a taxable benefit. If it's a taxable benefit, they needed to include it to their income. You're getting these painters because you work for the company, and that's the first of it. And the value of these paintings were $2,500, but you're getting it for cheaper price. If you're getting it for cheaper price, you have to include a taxable benefit in your employment income. Let's go to number 3. One of the employee's friends work in the same employer and attends a birthday party. The friend gives a check of $200 as a gift. Now $200 definitely a benefit, but since it has nothing to do with employment, it will not be taxable benefit. So it will not be a taxable benefit. Let's go to number 4 and see what happens. The employee wants to purchase a home, but it has been turned down by 3 banks. So of course, if you purchase a house, you need a loan, and either you go to your employer or you go to the bank. You always go to the bank first and then you go to the employer. The employer does business with one of the banks and calls them, agree to personally guarantee the mortgage as long as the employee is working for the employer. The employer receives this mortgage. So that means the employer is co-signing. Of course, they received a benefit, and in receiving a mortgage, which would not have been obtained if this employee wasn't working for this employer. Now so the employee is the beneficiary of this house. So they have a house, he or she is the beneficiary of it, but however, we don't know the dollar amount of this benefit. If you cannot indicate the dollar amount, if there was a dollar amount, it will be a taxable benefit, but since we cannot tell what the dollar amount is, it will not be it'll be difficult to put in it with put it as a taxable benefit. So but if there was amount given, it will be a taxable benefit, because you would not get this benefit if you weren't working for the company, and you would not get a mortgage if your employer wasn't the guarantee for your mortgage. So that was the theory behind it here. Now we have a next part is GST on taxable benefit. And what is a GST on taxable benefit? So what you're doing is, sometimes what happens is we have a benefit that is given to us, and then that includes a GST. If it's includes in GST, what amount should be a taxable benefit? That's what we're trying to do. Miss Vicky Kroll, as the results of outstanding, so she's been doing very well in her organization. What they do is they awarded her 2 weeks of vacation, and what the her employer pays behalf of her to a travel agent. How much they paid them? They paid them 4,500 plus the HST, which we call it a GST amount. If I add the both numbers, it is 4725, and it becomes a taxable benefit because the company paid this benefit, paid this agent behalf of you. So it will be a taxable benefit for Miss Vicky Corrali. Now, next one we are leading to is taxable benefit when it comes to automobile. One, if automobile is owned by the company, the other one is leased. So one is owned, the other one is leased. So first one we are going to do owned, and then we're going to do a leased. So in this case, we needed to know how much they paid, and then from there we could figure out what's happened. Miss Connie is provided an automobile by her employer. The employer purchased this, and this one was for, they purchased, and this asset, how much they purchased it for, 25,000 plus the GST. PST, we learned in accounting, PST is not refundable. So you're gonna, the cost to the company will be 25,000, and plus your is a PST is refundable, but the company at itself, they're paying for it. So 25,000 plus my plus my GST, that is 1250, and plus your PST. So in Ontario, we call this an HST. We call the both amount as an HST. So if it's an HST, we will include it into my into your cost. So that will be, what number will be that? 054 626 450. That's what the cost to the company is. Now we needed, that's the cost. So what we do is, there's two things we needed to know, if even though if it's a leased or it's a purchase. So first we needed to worry about the standby charges, then we needed to do operating benefits. Those are the two things we are going to be doing, regardless of if the person if the asset if the automobile is owned or leased. So when you're doing a standby charge, the formula says 2%. First of it's 2% of what? 2% how many months this car was available to the employee. So if they don't tell you, if they don't tell you, they'll give you some kind of an indication. The automobile was available to Miss Woogie throughout the entire year. So how many months it was available? 12 months. What is the cost? The cost is 26,450. And then what we're gonna do is we have to multiply this by what we're gonna do is we have two things. One is, they told us in the question, the total kilometer driven is 28,000. Part of was a personal, and part of was employment. So my employment was 16,000 kilometer, and for my personal was, for this employee, was 12,000. I needed to know, is this, they drove for the car they driven, is it more than 50% relates to the employment? It seems like it. If I do it divided by 28,000, it will be more than the 50%. So it will be, I think, something like 57.1%. So if it's more than 50%, your operating benefit will show you how to calculate the operating benefit. In this case, we know the personal driven is $12,000, and then what we needed to divide this number by the maximum number that we allowed is 1667 per month times the 12 months. So when you work out this number the way it is, first you solve for this, then you multiply by across, you will get number 4067. Since the employment driven was more than 50%, what we got, the operating benefit will be lesser of, I will show you, a prime benefit will be lesser of. First you have this is a prescribed rate is given to us in 2024 was 33 cents, and the personal driven is 12,000, and that is your 39.60. Or we're taking operating better lesser of these two number. This is my first number. My second number will be half of the standby charges, so that number will be your 2034. Which one is my lesser? My lesser amount is 2034. What will be my what will be the what will be this employee's total automobile taxable benefit? Automobile taxable benefit will be, if I add both numbers, then I'm going to add these two numbers. If I add it, it will be 6101. That will be my that will be the taxable benefit. If this was not available, if the personal employment was less than the 50%, this does not apply. So this doesn't apply. So let's go to the next one and see if we can do my next one. Either you own an asset, company owns an asset, or they lease an asset. Next one is something called leasing an asset. So when you're doing a lease an asset, so when you do a lease an asset, you still have to do a standby charge. When you do a standby charge, we take 2 divided by 3. That's what it is. What we're going to do is then you multiply this by the whatever the monthly lease payment we made, which was 525, plus what we did is plus my HST, then the rest is exactly the same. We want to know how many months this was available. They said that that leased his employer throughout all the year, and then we wanted to know how many months this asset was available to the employee. So they said the monthly lease, it was 525 plus the HST. The automobile driven was 40, total driven was 40,000, 37,000 was for employment, and the rest was 3,000 was for personal. So this will be more than 50%. If it's more than 50%, you will allow to do a allowed to use it for half. Will be allowed to use half of the standby charges. The automobile was available for 325 days during the year. If I were to think about it, there are 365 days in a year. So if it was a 325, we think of it, it was only available to them for 11 months. So it was not available to them for the whole year. It was only available to them for 11 months. So multiply by the 11, and then my personal dividend is 3,000 divided by 667, and then the car was only available to them for 11 months. If we work it out, all the numbers, we should get an answer of 711. So that's my standby charges. Next, we needed to do my operating cost benefit. That does not change from the if they own it. Cost benefit, when you do that, I have what do we do have here, 0.33 times the personal driven, which is your 3,000. It is lesser of these two amounts, so that will be your 990. Then half of the standby charge of 711, and that will be 356. The lesser amount is 356. I added, and this will be my total automobile benefit that will be included in this employee's income. So that's how we do that. So let's look at the next one and see what is the, if I add both numbers together, I will get 1067. Let's go to my next one, is my automobile deductible automobile expenses. So now what happens is that when you think of allowance, is not based solely on number of kilometers driven for the employment use. It is deemed to be, if I were to think about it, Miss Lauren Gumco required to use an automobile. She leases the performance. She leases in the performance of her employment. She receives a flat rate, so they're given a flat rate which is $3,600 for the use of automobile. During the year, she drove 24,000 for personal. No, total driven is 24,000, which was 65 was personal, and 17,500 um, was your this was employment, and was my personal. Her total automobile expense for the year, including the lease expense, was 7150. So that's how much was the lease expense, automobile expenses. So then I multiply this by, what do I needed to do? I needed to do 6,500 divided by the total driven. That was your 2,400. um, so what happens is, if now there's certain conditions are need to be met. They said determine the fact that these fact on employment income in the current year. So first of all, she's required to use an automobile that she leases in her performance. So she this is her car, and she's required to use this car. If she's required to use this car, so then it is not depends on, um, she was given a flat rate for the year was 3,600. So if we were to think about it, if they given her $3,600, so that's what they were given her. Part of was employment, and part of was not personal use. If this she was given that amount, this part was used. If this was her total expenses, this was her employment use. If it was employment use, we need to deduct those employment use, and it works out to be 1936. And then what she would include it, what will be her taxable income? Her taxable income will be, difference between those two will be the benefit was given to her for her personal use. So benefit that was given to her for personal use, she will be including this into her, this will be her taxable benefit. Miss Lauren will be including this income in her taxes. Now going further, now this is similar. We want to know if they will be this will be deductible, to include it in the income or not included in the income. Again, it is not just solely on the number of kilometer. The rules says that um, the the Income Tax Act, I'm going to put it in here, 61 BX would not apply. Because why wouldn't apply? Apply to deem as a reasonable allowance to be unreasonable. So if the amount is unreasonable, then we needed to worry. But at the end of the day, what we have to do is, we want to know if how much of this how much of the automobile expense that are the allowance that are paid is deductible, and how much is not deductible, or how much is taxable, and how much should be included in her income. So let's look at it. In this case, it's Jacob Lorge leases an automobile, $450 a month, and the total of 54. So Jacob has a car. He uses this car for 5,400. And when we think of it, how much is the total driven? The total driven is 60,000. Out of that, 35 is a business employment, and other 25,000 is my personal use, similar to what we did. So it's similar to what we did. So so this is the cost to him. Also, there is the other cost is that this is the cost of just the lease, and he also has to pay $15,000 for operating expenses. Maybe insurance, could be other things that he had used, maybe gas, all those all those things. So when we are to do that, I multiply this by 35,000 total employment driven, 60,000 total driven. And what do I get it? We get a employment expenses. So this will be the employee is entitled to the employment expenses of 11,900. So these are, he is entitled to the employment expenses for that much. Now reading further, the employer, what happens? The employer pays him. How much the employer pays him? They pay him 10 cents for the employment use. So the employment use is 35,000. So Jacob is getting an allowance. So this is 10 less allowance for that much money. So his expenses was 11,900. He was getting something from his company. So in this case, minus the 11,900. So whatever the difference between the both is 8,400. So this will be a deduction from his, it will decrease his income. So because his expenses that he paid was more than what the allowance he received, so it will be called a deduction in his employment income. This will be, his employment will not go up, it will not go up, it will go down. So employment income will go down. So let's look at the next one, is disability insurance. So what happens is that Mr. Lance Bodwell is a member of, first off, it's a group of disability. They're not providing this benefit to just this particular person. They're providing this benefit to group of disabilities. The plan provides a periodic benefit to replace the employment income if an employee qualifies to make claim under this. Now, so the plan provides a periodic benefit to replace the loss of employment income. So then we want to, in this case, we are going to look at it, how much was Mr. So then this plan, the company also is sponsored by his employer. Some money he pays out of his pocket, and some the company pays it. So there is a, if the employee contribution is 300 to the plan, the employer contribution to the plan is 18,000. During the 6 weeks of 2024, Mr. Budwell became disabled and filed a claim, and that paid him 52 disability. So he received a benefit of 5250 when he was sick or disabled, and that's the money he received. Because of the period, his personal contribution plan was only for 225. So then what he did is he paid $300 for the plan, and his personal 2024 contribution was 225. So altogether he paid 525 out of his pocket, but he received what? He received a benefit. How much benefit he received? 525, and he paid this out of his pocket. Difference between those two will be my 4725. It will be an employment benefit, it will be your taxable benefit. So it will be included in the employment income. It will be included in the employment income. We call this a taxable benefit. We call this a taxable benefit. I didn't spell right. Let's go to further and see if we could pinpoint what's happening with the next one. So next one is how loan. So the next question relates to loan. What happens in the loan? You get a cheaper loan from the employer than you get it from the bank or any other credit union or a private lending. So we wanted, there's something called the prescribed rate. So we are given a prescribed rate. So these prescribed rate changes every year. So 4% for the first quarter, 5% for the second quarter, and 6% for the remainder. So 4% if I were to do that, 4% for the first quarter, and 5% for the next quarter, and then 6% will be your 2/4, because that's for the other half, right? So that's what we're looking at for the other half. So let's look at it further. Now we wanted to know what will be his taxable benefit. So let's see what will be his taxable benefit. Corder receives 100,000, receive 100,000 from loan from the employer. So the loan this person received 1,000. So this employee received $100,000 mortgage to purchase it. The loan requires an annual payment. So these are the prescribed rates that are given to us by Revenue Canada. The rate this employee is getting is 1%. We want to know how much should be the benefit that is be included in his income. So that's what we're looking at. So what will be the employment benefit on this loan? So when I were to think about it, now if you look at it, we look at the lesser. What are the lesser? So first we know how much is the loan, multiply by your 4%, multiply by your 1/4. Then I take then my next one will be I have to work it out for the full year. I still have the same loan, but now my rate is prescribed rate is 5.5%. That's for the next one. I then add my 100,000, multiply by your 6%, and that times your 2 divided by 4. And what does that give me? It'll give me some number. I think it should be equal to 5250. Then what we do is we take a lesser of this amount, or what we have is we have when we think of it, prescribed rate. So my prescribed rate for the full year will be 4%. So lesser of those two, of course the number will be, the lesser number is 4,000. However, this is the taxable benefit. This taxable benefit is reduced by how much? The employee, what they're doing is they're paying the employer 1%. How then it will be $1,000. His taxable benefit will be $3,000. So if it's a taxable benefit, it will be included in his income. So taxable benefit will be included in his income. So the annual benefit, where this comes from, your annual benefit cannot exceed the 4,000. In this case it exceeds the 4,000, so we will take the 4,000. The limit is the 4,000. So let's see if we can go to the next question and pinpoint where we could go with the next one. So next one is a stock option. So when we next one is stock option. You could be having it from public or from a private corporation. So the only difference is if it's a private CCPC, then you defer your benefits till you sell these stocks. So let's look at it and work out what should be included and what should be not included. So sometimes it's good to put it in the questions the way it is. What should be included in the income? So in this case, it's in October 2020. Mr. Musa was granted stock option to buy 25 of his employer's shares at $23. At this time, the shares were trading at $20 per share, which is the fair market value of the share. So what happens in this case? That's the price, right? So at the time the shares were trading, Mr. Moose's employer is a larger public corporation. In July 2024, he exercised all the stocks when the shares are trading at $31.50. So what happens is that he's getting it for, Mr. Musa is getting it for $23 when the shares are trading at $31 $31.50. So that's what happening. 31. This is um, what's happening with he shares are trading at 31.50, but he's getting at $23. So we know that there's an increase. You have to increase your employment income. And how do we increase it? We know the fair market value of the share at the time was exercised was $31.50. How many shares? 2,500 shares. So that's the fair market value was 78,750. What is the cost? We call it ACB, or you can call it a cost. The cost of these shares would have been 2,500 multiplied by the 23, and gives me 57,500. So he got the benefit. If you got the benefit, how much benefit you got? You got a benefit of 21,500, and that will increase your employment income. So you will have to, if you were Mr. Musa, you will have to increase your employment income. And then it will be when he exercised the option. In this case, it was exercised on 2024. Then half of the we call it stock option deduction. So stock option deduction applies. What is the, first of all, how much is it? Half of the employment income. So your half of the employment income is, you reduce the employment income by half, which will be 10,625. So 10,625. So that's how much you reduce it by. Then what we're going to do is, what will happen, this was employment income, you will allow a stock option deduction, and the increase in your taxable income will increase by difference between the both, which is 10,625. Your taxable income will increase by that. However, you, in September, what you did is you exercise the price, you exercise your shares, and you also, what you did was you sold the shares. So if you sold the shares, we needed to know what's happening with the shares. They sold the share for $28. So when you show, when as an individual, your proceeds, or we call it POD. So you sold all the shares, in this case 25, and you got the proceed, your proceeds were $70,000. So now, even though the cost to you was 23, but the fair market value of the shares were $31.50. So what happened? Your adjusted cost base. So this was the cost to you. This is the adjusted cost base after your 2,500 shares will be 78,750. Now the cost was more than the proceeds. So what we have is, we call it a capital loss. So we have a capital loss, and then my taxable loss will be, half of that becomes my 8750, half of that becomes my 4375. We call it a taxable loss. Taxable loss will be applied against, your taxable capital gain. So taxable capital loss is against your taxable capital loss. So that was the your if the company was public company. So now we're going to do the next scenario. Next scenario is if the company was a private company. If it was a private company, and then what happens in this case. So that's what you're going to be looking at it, what happens in that case. So what happens in this case, on December 2022, what they did is, they were granted a stock of 18,500. At that time, the shares were, the price was this, the fair market value was 45, and the $42.50. And so there is no consequences for the year 2022. So we when we think of it in 2022, sorry, we in December 2022, there's no consequences because the stock was guaranteed, or in 2023 when they exercise it. So what we have to do is all the rule applies the years you sell it. So in this case you have 2 years after that. That's when all your consequences will happen. So we wait till the 24 to get your um, to get your deduction. So if you own less than 2 years, your deduction does not apply. You have to own more than the 2 years before you could sell it in order for the deductions to apply. Now when you're looking at it in 2022, there is no consequences. 23, there is no consequences. Now we are going to go into my 24. That's when I exercise my options, and I have to record. I have to find out how much amount should be recorded in 23 and which one should be recorded in 24. So nothing in 23, but something has to be recorded in 24. So your income is deferred till the following year. So that's what happens. Your income is deferred in the following years. So now what is my employment income, or how much is my taxable income increase? So what happens is that the fair market value of the assets of the shares that we purchased was 1800 multiplied by the 75. So that's when we put the share was guaranteed on the 23, but then you have to keep it for 2 years in order to have a deduction that is available. So in this case we sold it in the same year. So fair market value of the shares when we acquired was 135000. The cost of the share was 1800, and the cost to us was 42. The individual was 4250. That is 76,500. So what we have is we have to increase my employment income. When you increase your employment income, and that will be increased by 58,500, and then the deduction deduction C does not apply, means we cannot take half of that. Why can't we do that? Because we only own the share less than 2 years. So that's what happens. You less than the share. So we want to know, are they in money? So they weren't in money. If they weren't any money, so we don't need to increase any net income. So our net income will increase further. How do we do it? We take the option price, and then we compare to the fair market value. Option price is when you think of an option price, they have to be in money in order to increase my income. So there is no deduction, and there is no deduction for that I needed to add it to my employment income at this point. So my taxable income will increase by default. So there's no deduction C because I did not hold these shares for 2 years, so I don't have any deduction. And there's no extra income because they weren't in money. So they weren't in money. However, we have a taxable income. If it's a taxable income, I needed to increase my taxable income. Now we want to know if there's any capital loss. So loss only happens at the time you sell it. So when you sell it, you're going to get a proceeds, you're going to have ACB. Difference between those two will be my capital loss or a capital gain. Half of that will be allowable. So what did we do? We sold it for 88,200, which is $49 a share. And what we did is we purchased it. What did we purchase it at? The fair market value of the share was 135, and we have a loss. My loss will be 46,800. Half of that will be a taxable capital loss, which will be your 23,400. Now we are going to do one more question. I know I'm doing a lot of questions, but now next one is a commission person. So under what happens is if you under one act you're limited to your commission income, and if you have, there's two acts that are available to us. One is Income Tax Act 81F, and then we have ITA 81 and it is H. So under F, what we have is our deductions are limited to our commission income. So whatever your commission income is, our expenses are limited to our commission income. However, you can have a further deduction, but you cannot use both simultaneously. So you cannot use both simultaneously. So let's see how much is my deduction, and then we can pinpoint what will be under one act and what will be under the other act. In this case, the commission income is 12,200. So my expenses are limited to that. So in other words, I cannot generate a loss. So the person has a gross salary. We don't care about the gross salary. We only care about the commission income. So this person has an advertising expense. So the person's advertising expense was 8,000. So we have advertising expense of 8,000. When we have an entertainment and meals and entertainment, allowed expenses are only 50% of that. So entertainment expense was 12,000 multiplied by 50. My expense will be for $6,000. Going further, we have travel expense. The full travel expense is allowed, so my full travel expense will be 8,000. Then I'm going to go further. Then it says 13,000. Oh, sorry, I have this is not my travel expense. Sorry, I wrote it wrong. So this is not my travel expense. So it says that the entertainment expense is 12,000. His travel expense is 13,000. 3,000 is a meal. So when you think of a travel expense, the total travel expense was 13,100. In that, we have to minus the 3,000. That gives you 10,100. Then we have a meal. Meal and entertainment. They both are going to be at 50%. Then 3,000 times the 50%, and that is your 1,500. Altogether, if we add them, and we are going to get a number, the number will be 25,600. So these are my deduction. My expenses are my deduction, but we're limited to 12,200. So then you only allowed to allow the expenses up to that to make your commission income to be zero. The deduction for the expenses you are allowed is only 12,200 because my net income, my commission income was 12,200. The rest of the expenses I'm not allowed to deduct it. However, when you are when you're in part H, you cannot do both. When you're in part H, you cannot, if you were to think about it, you will take the meals and you cannot deduct advertising or entertainment. They're limited. So in this case, what we are going to do is my entertainment, my travel and entertainment. So let's look at your travel and entertainment. My travel expense was 10,100. My meals was, what was my meals? My meals was 3,000. I'm allowed 1,500. So then under the meals, under the H, I'm only allowed the travel expense and half of the meals, and then that will be my 11,600. Under the H, we're not allowed to deduct what? We're not allowed to deduct the advertising expense. or an entertainment expense. So these are the only ones that are available to me. If these are the only ones that are available, that is equal to 11,600. But I cannot do both, so I rather take the one with the 12 more expenses. So under F, my expenses are limited to 12,000. Here my expenses are 11,600. So I will take the one with the more expenses. So more expenses are under the F, under the section F. So these two are not allowed, so we're only left with these under the H. So your total expenses that will be allowed will be 11,600. If my commission income is 12,000, and then my expenses will be that, I will be paying taxes on some income difference between those two. I will pay taxes on it. I rather not pay any taxes, limit my expenses to my commission income. This was for chapter 3 homework. Thank you for watching my video. Take care and bye for now.